This is the second video about mini-perms. And the issue, one of the big issues here really, is to evaluate the credit of a mini-perm. You need to first structure the debt, structure the amortization of the debt, and then switch the whole model from a structuring mode here, perhaps I'll push it up a little, and then to a credit analysis mode. Now, in the structuring mode, I've had maybe too many videos on structuring, and it always causes a circular reference. And we have the difference between the DSCR constraint and the debt service constraint. In the risk analysis mode, I think so much is about a cash flow waterfall and using the min and the max statements. Okay. And min, max. Now, and then in this video I'm going to show you just a little how to do the default. I'm worried that I didn't emphasize it enough. I didn't emphasize some of the risk analysis kind of techniques, which are always the same, min, max, get the data from the cash flow statement, but this time we'll put some default interest. And you don't know that you defaulted until the last period, so you can avoid any circular reference by just using the last period default. And then the very last thing is we have to figure out kind of how to determine when we finally pay off the debt, because debt service coverage ratios, DSCRs, do not work. They do not work if you have a cash flow sweep. If you have a cash flow sweep, and this banker, she was brilliant, really, she told me, here's what I want to do. I want to take and size some debt. So here's what I'm going to size the debt from the downside case. All right, and let's make, if we're in the downside case, maybe we don't need that much of a buffer. Okay, and we're going to make, I understand that, well, this might be too much. Let's put a 1.2 times against a downside case with all sorts of different assumptions about growth rate and traffic and everything else. Okay, and then we click on the credit analysis mode. And there's a copy and paste. There's a copy and paste routine there, and I hate copy and paste routines. I really do. And then we're going to figure out how to get rid of those. Now, when we do this, I'm going to switch it back. Here's the thing. You better make sure that the amount of debt is the same. Now, I have all sorts of problems doing this if you don't care. But we'll show you how to switch it in I don't know what the order of the video is. Another video will show you how to switch it in 2 different ways. Okay, and then I said, oh, let's apply a cash sweep. And if we apply a cash sweep, here, the difference between a hard mini-perm, this would be a soft mini-perm, where you have most of the amortization occurring during the initial period, if we go to, and then a hard mini-perm would be when you just have a few years. The issue is exactly the same, or not exactly the same in a way. The issue is what happens in the downside case. What happens if things get worse? If things get better, and you go, now in credit analysis mode, and you go to the base case, that's going to be pretty boring. You're going to be able to easily pay off the debt. Okay? The problem is in the downside case, what happens if some things get worse? I'm going to say, well, we can't charge enough toll rates, or the base traffic, the base level of traffic goes down. Now, when I do this, I have on the, excuse me, I meant to look at a macro. I say, okay, we're going to switch, and we're going to switch everything, and we're going to do something very simple. We're going to switch the scenario code whenever we click on this spinner box in the summary page. We're going to switch to the very last scenario. I call this the break-even case. We're going to switch to that one, okay? And then So if we push this down, let's keep pushing this down. We should have maybe started with the base case. Okay. And then, here, I wanted to show you this. In this case, we do pay off the debt, but we have a default. And then we're able to refinance the default. We have to refinance the default, and then we can continue paying off the debt. If it wasn't in a mini-perm mode, you can still repay the debt. This is the basic debt, and this is the defaulted debt. But if we keep pushing the traffic down, eventually we get to the point where we can't pay off the debt. That's our break even. And if we have a mini-perm, frankly, it doesn't make much of a difference to the, well, maybe a little bit. Okay, so we repay the debt, and then we repay we refinance the default rather, and then we repay the debt with and then we can again see how low we can go. Up there we are until we cannot pay off the debt. Okay, and that's what she wanted to know, and she was right. The whole thing is, how long does it take us to repay the debt? And in order to do this, we better model the cash flow sweep, and we better model the default on the debt. And if we model the default on the debt, we should probably put a default interest rate in there. So in the assumptions, I've said this so many times, but I don't mind repeating it. You basically work through every single thing. Every number in the term sheet probably should be put in your model somewhere. Every number in the loan agreement or the term sheet. And one of the numbers, when you go down to interest rate, maybe we add an extra % for the default interest. So here's our regular old credit spread, and it should be going up. Let's make it go up, because I learned that we really have to go up by 0.25%, 25 basis points. Of course I did it wrong, but whatever. Okay. So then we can put our default interest rate, and I put a base rate here, okay. Now when we go into our financial model, I'm just this one, thankfully. I'm not going to type anything in. We start with all the operating analysis. And it's a nice, simple operating analysis. You don't have to spend a whole lot of time on that. I mean, for this one, I don't know what that meant, whatever. And then we have our funding analysis, and then we have our debt repayment. And under the debt repayment, then we really go through our interest. And our interest, we can put the interest rate without a default, and then with a default. And the default switch should be, now, just before I get to that, well, we're going to keep track of the defaulted debt. Now, I'm just going to tell you, I used to try to put the defaulted debt up here. I'd say, okay, let's try to pay the debt off, and then subtract the debt we can't pay off, that's our defaulted debt, and then put a line for repayment of the defaulted debt here. I never got it to, it makes it a mess. It's so much cleaner to just put a opening balance, and you get the defaulted debt from the cash flow statement, and you get the repayment of the defaulted debt from the cash flow statement, just like you get the cash flow sweep from the cash flow statement, because you don't know the defaults of cash flow sweep or the repayments of the default until you have the cash flow statement. And then we can refinance that defaulted debt, and then we just have a balance like we do for anything. Now if you have a defaulted debt, so if this balance is greater than 0, I put greater than a little 0.1, and you have some defaulted debt, and I think, we use the conditional formatting, so here we had some defaulted debt, so our interest changes, and all we do is change the interest rate depending on this. I think we had some defaulted debt in this year, so we look at the last year, because you don't know the default till the end of the year, in the end of the period. This is a quarterly period. So then you go to the next one, and you've got some defaulted debt, and eventually you paid off or you refinanced the defaulted debt, so I took it away. Now that you'd have to understand the term sheet to do that. And then this actual interest rate depends on whether the default switch is there or not. And then, just to go down, I don't think this is all that complicated. Okay, we've got to fill in, I've got all this defaulted debt, mini-perm debt, base debt, refinancing. If you don't put a balance sheet in, I wouldn't trust the model. So I haven't put the balance sheet in yet. And I'm not going to burden you with a video on that. But I just do want to tell you that the default debt, you just put a max min switch. You could even put a minimum switch, because if you never default by more than the total debt service, but I just put a maximum. And then I said, okay, then after that, if the cash flow is positive, so you put a maximum of the debt or zero. This one I didn't explain well enough, sorry about that. This one just says if this is less than zero, so you just take, and don't use an if statement, you just put a maximum of a minus this or zero. That says if it's a negative number, switch it to a positive number. If it's a positive number, then you switch it to a negative number, and the bigger of a negative number is zero, blah, 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 blah. Blah! Okay, and then this one is, and then you don't, if you have some defaulted debt, you're not going to repay the defaulted debt unless you have a balance of it. So when this number finally gets positive, so let's go and look, and again, we'll look at we start, we have some negative cash flow, so we've defaulted on the debt. And we keep defaulting and defaulting. And then, guess what? We repaid all the defaults. And then, since we're refinancing our mini-perm, we don't have any, we have interest expense still on all the debt. I just globbed that into one. But then we don't have any repayment, and we're going to use any cash flow we have left to pay the sweep. And that's another minimum and maximum statement, and you don't repay it. Now this one, so you don't, this is the minimum of this, the AA 124. Well, that's just going to be the opening balance. It's always the opening balance. That's our rule, again and again and again. I think I did that in the simplest cash flow, the simplest project finance model. I think we did it in the LBO model. We do everywhere, a min-max and a min-max. And there are just two big rules. You take all of these numbers come from the cash flow statement. Sorry, all the cash flow sweeps, all the defaults, everything else. So we have this cash flow sweep. That comes from the cash flow statement. This, I'm repeating myself, I know, sorry about that. This comes from the cash flow statement. No formulas, no complicated formulas in the debt schedule, only the complicated formulas downstairs in the cash flow waterfall, and those formulas are just min-max, min-max, min-max. And that's the big deal about credit analysis rather than structuring. Now, I should have said this before. I want to tell you something really exciting. I hate, uh-oh, and then we put true. I hate the copy and paste. Now I'm gonna have to do this. Sorry about this, but here's the function. There's a wonderful little function. Don't worry, I'm gonna have to fix this thing. Don't worry, we're gonna show it to you next. It's a little embarrassing. It's not a little, a lot. If I put true here, it just says, okay, take the numbers. Now, there's a little function. Let's say I change this to 50, and then it changes it to 50. If I put false, I don't want to use the new value, and then I change this to 70, we've got like a flexible copy and paste special macro, and I'm going to try to show you how to do one of the hardest things here is to switch it from credit analysis to risk analysis. And I hope you understand the importance of this. Let's put it back to the base case, and let's put it back to the, credit, whatever. Okay. We changed it. That's our, I've told you this too many times, sorry about this. It's just doing some sculpting, and then if we don't want to do sculpting, we can make it a level 1, and all of that stuff, okay? I had to do a goal seek there, okay? And then we put a little bit lower coverage ratio and get a little bit higher debt. We see if our maximum debt to capital constraint is violated and all that. And then you have to click on this and see, uh-oh, we're going to fix all the debt, and then we're going to, if we click off of this, if I click off of this and on this, it's got a copy and paste, and I hate copy and paste. And I'm going to try to show you how to use that little function to do it, and I'm going to do it in a simple way first, and then show you how it works in this model. So that's another video. I probably shouldn't have done that right now, but whatever.